Oh, you're absolutely right. In terms of that point, your last point there, technology and comm services is 38% of the S&P 500. You know, I've been underweight technology for the better part of the last year. I've actually this year narrowing the names that I own, because the problem is these FANG and Microsoft kinds of names, they're so over-owned. Not only are they over-owned, Scott, but the sell side just loves them. And it's been the right call, by the way. These stocks have been amazing up until about a year ago, right? And we've seen a lot of problems this year. So a lot of cracks right now. I only own Meta, Facebook. You know, I'm sitting with a loss on that, but I do think the valuation is the cheapest of the FANGs. The expectations are very low. Total revenues have come down 700 basis points for 2022. That is an enormous number. And the company still has 2 to 3 billion DAUs and MAUs, daily active users, monthly active users. And I think that the advertisers still find value in that. They're getting better returns on their investments because of the eyeballs. So this is not one that I think is stretched. I don't think any of them are stretched, but this one I think could bounce. The expectations are very, very low. And then Apple, we can get into that, but that's more of a defensive play in my mind, because it has, you know, just strong brands and products and services and recurring revenue, and they're going to announce a buyback that will hopefully actually give them some support. So I am very, very underweight tech and comm services. I'm looking to buy if I get a good reason, but I think we're too early.
Well, I mean, you're justifying the reasons why you would keep a Facebook, for example. And yes, right, they have all of those users, but I just wonder, and Alphabet's going to give us a good read on this tonight, what Alphabet says. Yeah. What Ruth Porat, the CFO, says about the digital advertising market, right? If you have a duopoly essentially between those two, Alphabet and Facebook, if you have worries about a global economic slowdown, that's one of the first places that you would see it show up, right? You would get commentary from a Google who would talk about what the digital ad market looks like, right? We've got some commentary already out of that from Snap. So pay close attention to that. I also wonder, 100%. Amy, you know, I also wonder, you know, you have, as somebody texted me a little while ago, a money manager, again, I'm not going to reveal who exactly it is, but they say what you're witnessing today is the intersection of higher rates, not today, obviously, but generally speaking, with what the Fed is going to do, plus recession fears and the notion that forecasts are going to have to come down. I mean, that's a natural progression, right? If you're going to get higher rates, if you're worried about a slowdown, and then you're ultimately going to get forecasts coming down, that's going to hit stocks, and especially some of the growthier names. You trimmed Alphabet.
It could be
right? And I came to you last, Amy, on purpose, because I wanted to get everybody's commentary and then to come to somebody who was actually making a move into the number tonight. And that's you. Somebody who's been more negative than most on the market of late. And I recall our conversations over the last, I don't know, 6-8 weeks, last time you were on. You definitely have been more negative than the others, and you're expressing it through a trimming of shares of Alphabet into the number in 3 hours.
Right. Well, I'm not betting on the quarter tonight or the results. I don't know what the company is going to do, and I still own it, so I hope that it is a good number. But we have been more negative on the markets and on big tech in particular. I mean, and you can even take it further than, the last 2 years. The only trade that you really needed to know for the last decade was to buy big tech. And they really benefited from a disinflationary environment, and they had a lot of multiple expansion. Yes, earnings were good and growth was good, but these are now the dominant stocks in the market, as Josh said, as they have a disproportionate amount of revenue, a disproportionate amount of market cap. They're widely owned. They're widely loved. They're owned by people who don't even know they own them in large sizes by just people who own passive indexes. So, where's the marginal buyer here? And, expectations are really high, even though the stocks have come down a lot. If you just look at the numbers and the expectations, they're high. So we think this is, we've been early on getting out of the FANGs, but we don't think this is the place that you want to be for the next decade.